what I thought we could talk about is first we can try to define what momentum is and talk about the various ways it can be measured and how it sort of is incorporated in the models that we run. And then maybe some of the reasons or the theories as to why it works and other unique ways that momentum can be combined with various things and, other considerations that one would want to consider and look at when thinking about utilizing momentum. So maybe to start, if you wanted to give a overview of the different ways that momentum can be measured, and then we can talk about maybe the why behind momentum as a factor.
Sure. Taking a step back, I think academic research sort of supports two major factors as being the biggest, the factors with the biggest excess returns. And those two factors are value and momentum. So momentum's a really important factor. And it's a factor a lot of people don't completely understand, because if you look at something like value, paying less for $1 of earnings or paying less for $1 of cash flow, that's something that makes sense to a lot of people. But buying something just because it keeps going up is something that doesn't make sense to a lot of people. But momentum is just as robust a factor as value, and in a lot of ways, it's a more consistent factor, which we'll probably talk about later. But the general definition of momentum is just buying things that have gone up. I mean, that's effectively what it is. It capitalizes on the fact that investors tend to underestimate the good news going on with companies, and so they don't bid up stock prices as much as they should in the intermediate term. And so if you look at a period of, say, 3 to 12 months, you can buy stocks that have gone up, and they continue going up more than the market, and they produce an excess return. And to go back to your question, talking about the different kinds of momentum, there really are two different kinds: time series and cross-sectional. So time series is judging something relative to itself. So a good example of time series momentum is trend following. So if I want to, say, exit a position in an asset or a stock, if it breaks below its 50-day moving average, that's an example of time series momentum, because all I need are the prices of that specific asset in order to implement that strategy. So I'm just judging it against itself. Then cross-sectional momentum is judging things against other assets. And so that's what's commonly used in stock, factor selection strategies. You want to invest in the stocks that have the most momentum, or the stocks that have gone up the most relative to their peers. And there's a few different ways to measure that. Relative strength has been a popular one for a long time, which just ranks all stocks based on how far they've gone up over any given time period, say 1 year, and then assigns a score of 99 for the stocks that have gone up the most and 1 for the stocks that have gone up the least. And then if you're following a relative strength strategy, you would invest in those stocks that have the 99. And we can talk about some more advanced ones a little bit later on in the podcast, but that basically is the general way that momentum works.